Hello, I'm David Frazier, aka the Market Monk, and this is our daily Market Monk show where we strive to tell you everything that you need to know, but nothing more regarding factors and developments that we expect to affect your investment portfolio. So today on Tuesday, June the 10th, we'll begin our show in the same way that we do every day by first going over the important news from around the world. And when I say news, I do not mean stories, which is what the major financial broadcast shows, and really any type of so-called news show on television, as well as many radio news shows, purport to tell you about every day. Well, I guess they don't purport, they do tell you stories. But I have found over the past many years that, I gotta say, actually, all of those shows tend to do just that. They tell you stories, and rarely do they stick to the facts. Rather, they focus on coming up with a headline that they expect to get a lot of attention and to affect people from an emotional perspective. But rarely do they go over any of the actual facts, and even more rarely do they discuss significant facts. Instead, they focus on a lot of things that don't really even matter. And we try to do just the opposite here at the Market Monk, and that's why I tell you at the beginning of all of our shows that we strive to tell you everything that you need to know, but nothing more. Meaning we're not going to discuss variables that are likely to have little or no impact on your investment portfolio. We're not going to discuss coincident or lagging economic statistics. I mean, we may do that on occasion, but we're not going to focus on the statistics because those statistics only give information about what's already happened. And you don't make money in the financial markets by putting your money or investing your money in a way that's reflective of what has happened in the past. Quite the contrary, the only way that you can make substantial money, at least in the financial markets, is to focus on what's likely going to happen in the future. And no one has a crystal ball, including myself. But what we strive to do, and what I've done for many years, is to focus on leading economic indicators. That is, economic statistics that I've shown to have a lot of value in giving you an indication of what's likely going to happen in the future. So that's what we focus on here at the Market Monk Show. So, having said that, first we'll go over the important real news of the day, very, very briefly, and then since we begin our new programming schedule this week, every Tuesday I'll get a little bit deeper into significant economics and sometimes geopolitical factors and developments concerning countries other than the United States, and primarily Europe, Japan, China, India, and Brazil. So, first of all, the news for today, and we begin by going over what happened in stock markets around the globe. So, all of the major stock market indices for the United States as well as Europe were essentially unchanged today. And I'm sorry, I think I need to throw one more country in there. I think that's true for Japan too. Yes, it is. So all of the major stock market indices for the world's developed countries of the United States, Europe, and Japan were essentially unchanged today. Meanwhile, China's Shanghai Composite Index rose very modestly today, while India's Sensex Index made a new all-time high today, and Brazil's Bovespa Index rose for the third day in a row today. However, each of those stock market indices, that is for China, Brazil, India, as well as for the United States and Europe, are showing more signs of topping on a very short-term basis. And I don't expect any big downturn here during the days and weeks ahead. But as I've discussed for the second week in a row now, we're seeing more and more signs that stock prices in general are likely going to pull back modestly and temporarily within the next few days. And, I thought this was going to begin last week. It hasn't yet, but it looks like it's more and more likely going to happen within the next few days. Having said that, there were no major economic announcements today from the United States, nor were there any major announcements from anywhere around the world today other than Japan. We did get one important announcement out of Japan today, which showed that machine tool orders, that is, orders for machinery in industrial manufacturing companies, rose sharply last month, and that's a pretty reliable leading economic indicator. But however, having said that, over the past few weeks, leading economic indicators for Japan have been somewhat mixed, so we might see a little bit of a slowdown there. Regarding geopolitical developments, there weren't any major geopolitical developments today, so let's get right into the trading action in stock markets around the globe. And what we're seeing is price momentum statistics for indices around the globe are at extremely high and what have historically been overbought levels, which have been indicative of a looming pullback in whatever given stock market index. Meanwhile, the Chicago Board of Auctions Exchange Volatility Index, the VIX, which is oftentimes referred to as the fear index, fell even lower today and is now at a level that historically has also been indicative of a looming stock market pullback. Secondly, the number of, or I guess I should say the percentage of, stocks that trade on the New York Stock Exchange have risen to a level that have historically been followed by stock market pullbacks. I think there's one other, and the New York stock advanced decline line was down today. So, anyone that gets the direction of stock prices or stock market indices right almost all the time, or claims to do so, they're lying to you. No one's that good. I've been very, very good at getting not only at forecasting major turning points in the U.S. stock market over the past about 15 years now, but I'm also very good at forecasting short-term changes in the direction of stock market indices around the globe. And it's because I just rely on a lot of statistics and that have shown to be very, very reliable. But I'm not going to get it right to the day. I mean, if I did, quite honestly, I don't know, I probably wouldn't be having these videos. I'd probably be out on a 200-foot yacht and just relaxing and enjoying myself. But the statistics that I follow regarding the short-term trading action in the stock markets has been accurate in forecasting the short-term direction of the stock market indices much more often than it's been wrong. So even though I expected a moderate pullback to begin last week, it sure looks like we're on the verge of that happening. Now, unlike many so-called experts, if I'm wrong about this, I'm not going to try to brush it under the carpet. I'll just come out and let you know, hey, I got it wrong. And what I'll do, instead of trying to come up with a bunch of excuses or trying to hide the fact that I was wrong, if I turn out to be wrong, I'll evaluate and figure out what I did wrong. Okay, enough about that. Let's so now for our Tuesday night shows, let's go ahead and get more deeper into what's been going on countries around the globe other than the United States. And primarily, I'm speaking of, when I say what's been going on, economic developments that occurred during the recent past, and some economic indicators that are good at forecasting what's likely to happen in the future regarding major economies around the world other than the United States. We covered the United States on Monday nights, and on Tuesday nights we cover other major economies around the globe. Those major economies being Europe, Japan, China, India, and Brazil. And what we've seen over the past approximately 6 months is we've seen improvements in the Eurozone economy and Japan's economy, and we've also continued to see numerous leading economic indicators for those countries suggest that the pace of economic growth in those countries or in those regions of the world, because there's several countries, of course, that compose the Eurozone, those indicators are suggesting that the pace of economic growth in the Eurozone and in Japan will increase during the second half of this year. And we're seeing just the opposite for China and Brazil. China's economy has slowed. My gosh, let me look at some notes here. Began to slow during the second quarter of 2010, and the pace of growth, even though China's still growing at a pretty darn fast pace, it's slowed, or it's trended lower. It's for the most part, it's slowed ever since then, and every quarter since the second quarter of 2010. And one of the more reliable economic variables that I'll refer to often is manufacturing activity. It's just very, very reliable leading economic variable is manufacturing activity. And what we've seen in China is we've seen manufacturing activity there decline during May for the 5th consecutive month. And several other statistics, leading indicators out of China, suggest that we're going to continue to see a slowdown through the remainder of this year. There was a lot of overbuilding in China, and I think that's pretty much what's really behind the slowdown. It's just, I'm talking about both homes and office complexes. From 2006 to 2009, there was just so much building done of homes and apartment buildings and office complexes, and banks there have made a lot of bad loans and have been more restrictive in their lending, and so there's a lot behind. Well, those are the primary factors that are causing this slowdown. I shouldn't say there's a lot behind it. Those are the primary factors, and it looks like China's going to continue to slow at least over the next 6 months. And we've also seen a slowdown in Brazil over the past approximately 6 months, and for totally different reasons than China. The reason, or the primary reason, my research indicates that we've seen a slowdown in Brazil was due to inflationary pressures. Inflation rates rose substantially in Brazil during the second half of last year, and as a result of those increases in inflation rates, and inflation rates getting at really high levels, excuse me here for a moment, as a result of those high inflation rates, Brazil's central bank raised lending rates there many times over the past 6 months, and Brazil's the central bank's key lending rate is now at 11%. That's a darn high lending rate, and fortunately, those increases in rates have started to reduce inflation rates over the past few months. But they've also caused the economic growth to slow considerably in Brazil, and I think we're getting close, I think, to that slowdown bottoming out, especially once we consider that the World Cup is about to begin in Brazil. We have the Summer Olympics coming soon in Brazil, and we're going to have a lot of building there. It's going to be a lot of positive economic activity going on because of those events. And given that these high interest rates have reduced inflation substantially, I think we're going to see a turnaround in Brazil beginning sometime within the next few months. Now in India, we also saw a slowdown in the pace of economic growth last year in response to India's central bank maintaining lending rates there at high levels in an effort to reduce inflationary rates and inflation pressures in India. And that has also started to have some positive effect. And at the same time, Indian economies still continue to grow at a relatively fast rate, even though there was definitely quite a bit of a slowdown over the past 9 months. And leading economic indicators for India, such as business expectations regarding the future direction of India's economy, as well as household expectations regarding the future direction of India's economy, have improved over the past several months. And manufacturing activity in India rose during May for the 7th consecutive month. So those are very, very positive developments in India. And I'm sure those are some of the reasons that stock prices in general in India is measured by India's Sensex index has made an all-time high today, and it's been trending sharply high over the past several months. And India recently elected a very capitalistic prime minister who focuses or did when he was governor in one of the regions in India, focused on economic growth and reducing government regulations. So I think we're going to see India's economy perform well during the second half of this year and probably over at least the next 12 to 18 months. Let's see, I feel like I've left out a country, have I? Or maybe I haven't. I've covered the Eurozone and Japan. Once again, some mixed leading economic indicators out of Japan. Some also a little bit of mixed indicators, meaning some positive, some somewhat negative regarding where Japan and the Eurozone economy is headed during the second half of this year. But it looks like we might have a little bit of a slowdown over the next few months. But in the aggregate, the economic statistics that I monitor on a regular basis for those countries suggest the pace of economic growth in the Eurozone and Japan is going to increase during the second half of this year. Just summarizing now one more time real quickly. Quite the opposite in China. It looks like we're going to continue to see a slowdown in China through the remainder of this year. Probably continue to see a little bit of a slowdown in Brazil over the next few months, but we're starting to get some indication that the pace of economic growth is going to increase in Brazil later this year. And that wraps it up, I think, for what's going on in other major regions of the world. So, I would not be advising people to put money in Brazilian stocks at this time, even though I think we're getting really close. I would not be advising people to put money in most Chinese stocks, even though there are a couple of Chinese stocks that look like they have some tremendous prospects for appreciating sharply over the next couple of years. One of those stocks I've recommended to our subscribers on numerous occasions, and anyway, I'm not going to name it here because our subscribers pay for that information. Japan, don't really have, not recommending stocks out of Japan at this time, and nothing in Europe at this time, because even though we're seeing likely improvements in those economies during the second half of this year, still, I think the U.S. is going to be the best place to invest for the biggest gains with the least amount of risk over at least the next 6 months. So that's all that I have for today. Hopefully you've gotten something out of this. Tomorrow evening on Wednesday is our stock night, where I every Wednesday I'll discuss stocks that I'm monitoring that are showing signs of appreciating potentially very, very sharply over the next few months to a couple of years. So I thank you for listening, and I'll speak with you again tomorrow.